Next, going to take a look at the option income strategy, which in general has been a very good strategy over the last several years with the volatile markets, because with the option income strategy, when you sell an option, you receive cash in your brokerage account, and that cash is a cushion for the stock in case the stock goes down in price. So the cash income provides a lot of downside protection with your trades. So it's a great strategy right now for volatile markets. So a lot of investors are not familiar with this concept of selling option premium to generate cash income. But it can be very lucrative. It's very simple to initiate in retirement accounts. So basically, when you sell an option, cash that's equal to the option price or premium is credited to your brokerage account. And unlike a traditional stock dividend, you don't have to own the stock on the dividend date to receive the quarterly dividend, and you don't have to wait a year to receive your 3 or 4% dividend yield. You get the cash up front, and it can be substantial, anywhere from 10 to 20 to 30% cash payment when you sell an option. Now you get to keep this cash payment regardless of the price movement of the underlying stock. So once that cash is credited to your account, you keep that regardless of what happens in the market. So it's an ideal strategy for the volatile markets. I'm going to show you a trade example of I bought Morgan Stanley stock and I sold a call option, and the call option was 30% of the value of the stock. So I immediately bought Morgan Stanley stock at a 30% discount. So if the stock goes down 20%, I'm still ahead. If it goes up, of course, I'm ahead. If it stays flat, I'm ahead. And even if it goes down 20 or 25%, I'm still ahead. So it provides a cushion and downside protection in these volatile markets, which is very important. So this gives the option income strategy a big advantage over just purchasing stocks and hoping that they go up. And it allows you to profit in any type of market condition. And the income strategy also works just as well with bearish trades that allows you to profit and receive income in bear markets. The key to selling the option premium to generate cash income is to make sure that the option that you sell is covered. And there's two ways to implement the option income strategy. For bullish trades, you can purchase the stock and sell the related call option, which is also known as a buy right or a covered call. And the second option for bullish trades would be to purchase a call option and sell a call option with a higher strike price to create an option spread. And then for bearish trades, you can purchase a bearish ETF and sell the related call option, or you can purchase a put option and then sell a put option with a lower strike price. Now, in both examples, the short option is covered, so this is a limited risk strategy. So we'll see some examples of option income trades that can profit if the market goes up, if it stays flat, or even goes down. So it's a good strategy for volatile markets and non-trending markets. Now this is just an example of an option sale. This was, I sold 10 contracts of the National Oil Well January 25 calls, and I sold these calls at $12.72, and I received $1,272 for each contract. Now, for 10 contracts, I received a total of $12,720. So that $12,720 was cash that was credited to my brokerage account for the sale of those 10 option contracts. Now, let's take a look at an example of the first type of income trade where you buy the stock and sell the call option. I bought the Morgan Stanley. I bought Morgan Stanley stock at $24.22, and I sold the 20-strike call at $7.27. So I bought 600 shares of the stock, sold 6 calls, and I received $4,362 in cash for the sale of the 6 options. So if you divide the $7.27 that I received for the call option by the cost of the stock, I received a dividend, cash dividend, that's the equivalent of 30% of the price of the stock. So I bought the stock at a 30% discount. So does everybody understand that basic concept of how you're able to buy stock at a discount?
You spread it out to the 4 months out then, instead of monthly.
The question is, do I spread it out to 4 months rather than monthly? This is an example of a 4-month trade, and I'm going to cover the 1-month trades here in a little bit. But this particular one example, this is a 4-month trade. So I'm getting to buy the stock at a 30% discount, and it's a 4-month trade, which is it's a good position to be in, because if the stock goes down, I'm well protected. And with the volatile markets, any given day a stock can be down 10%, even 15%. So this is a way to buy a stock and ride out the volatility, and you're not forced out of your stock position because of your money management rules. Now, when the option expires in 4 months, I can sell another option and receive another cash payment. This is called a rollover. You're rolling over the option. And if I roll over the option another time, I would receive a total of 3 cash payments over the course of a year. And if I was to sell another option and roll that over twice, and if it was similar in price to the first option, this would have the potential of generating a 90% cash payment over the course of a year. So that would almost pay for the stock itself, and it reduces your risk. So again, in this example, I can profit if Morgan Stanley stock goes up. If it stays flat or even declines 20 or 25%, I'm still going to profit. So there's a much higher probability that this trade's going to be profitable than if I just bought Morgan Stanley stock hoping that it's going to go up. So this has a much higher probability of being profitable than just buying stock. So this can result in a higher percentage of winning trades, even if your timing, market timing, is not very accurate. So this obviously gives the option income strategy a big advantage over a stock purchase strategy. And when you purchase a stock, of course, it has to go up or you're not going to make money. But with the option income strategy, it can go down and you can still make money or stay flat.